This book was born of the financial crisis. So I watched the crisis unfold from a trading desk at a big hedge fund. And I left that hedge fund and joined the U.S. Treasury Department in early 2009. I worked there on financial stabilization as well as financial regulatory reform. And I was convinced then and remain convinced that financial regulatory reform in the post-crisis period has been largely on the wrong track. And I believe the failure has been mostly conceptual and not political. So we haven't thought carefully enough about the nature of the underlying problem, and we haven't envisioned solutions in sufficiently structural terms. So I'm offering in this book a different way of thinking about how to do financial stability regulation. In the preface of the book, I suggest that we should approach financial regulation or regulatory design in general the way that Steve Jobs approached product design. So we should be aiming for simplicity and elegance. We should be skeptical of hyper-technical complexity. We should be asking what features we can safely omit. In short, design matters. Engineers sometimes say that simplicity is a prerequisite for reliability, and I think this is all the more true in the design and structuring and engineering of legal institutions. So the book has a programmatic dimension, but I should emphasize at the outset that the program isn't radical. In fact, in some ways, it's fairly conservative. The program builds on institutional structures and techniques that have been in active use for many decades in the United States. And I argue that our long-standing system of money and banking in the U.S. embodies a coherent economic logic. And the main task of financial reform should be to follow through on that logic. But first, we need to understand that logic. So, with that, let me start. If this works. Should have tried this before. There we go. What's the core argument of the book? So the book, as I just mentioned, is about financial instability. It's also about the structure of monetary institutions. And these two things, I argue, are one and the same. So financial instability is largely a problem of monetary system design. This may sound like a strange statement. We aren't accustomed to thinking of financial instability in this way. In fact, we're accustomed to thinking of these two things as really distinct from each other. But it's worth pointing out that in an earlier era, this statement would have been treated as self-evident. So if you asked Irving Fisher in the 1930s, or Henry Simons, one of the founders of the Chicago School of Economics in the 1930s, they would have said that this statement is a tautology. But we've, I think, lost sight of this insight and what it means, and as a result, we've approached financial reform with conceptual blinders. To set the stage for my argument, I want to first be clear about the problem I'm focused on. So here's a picture of the Great Recession in the United States. The diamonds here in this figure represent, I think my laser's not working, oh, there it goes. The diamonds represent U.S. real GDP on a quarterly basis. I'm going here from 2004 through the end of 2014. So we can see, of course, a major drop-off in real GDP with the onset of the crisis and immediately thereafter. The gray line in this figure represents the Congressional Budget Office's estimate of potential GDP. So this is what GDP would be if the economy were operating at its underlying potential, if we were at full employment essentially. So the difference between these two things, between actual and potential, is referred to as the output gap. And so we see a major widening of the output gap immediately after the crisis. But we seem to see some good news here in that the output gap has gradually narrowed since the crisis. In fact, we're operating at this point pretty close to potential. So this is the positive interpretation of this figure. But now let me offer you the more pessimistic and I think more realistic interpretation of this figure. So the plus signs here are the CBO's projection as of 2007, when it projected potential GDP would be going forward. And as you can see, the trajectory there essentially follows along the previous trajectory of the economy. And the CBO's current estimate of potential GDP bends down very significantly from what it had previously projected. And so this phenomenon is what Larry Summers and others have referred to as hysteresis. Hysteresis is the doctrine that the lack of output in the actual economy, the fall off in the diamonds, has in effect caused an erosion in the economy's underlying productive capacity. So this is like a muscle that atrophies if you don't use it. And the reason this is important is because it suggests the counterfactual scenario we should be thinking about is not that we stayed on the gray line, but that in fact we followed the plus signs. Right? That's the counterfactual macroeconomic scenario, arguably, that we should be focused on. And if we think about the crisis and the cost of the crisis in this way, it's much more troubling. Right? The crisis had a level effect on output. We appear to be on a trajectory, a permanently lower trajectory, to the tune of something like $1 trillion lower GDP than we had previously anticipated. And if you take $1 trillion into perpetuity and discount that back to the present at any reasonable discount rate, you're going to get a present value of lost output in the tens of trillions of dollars, which is just staggering. The reason I start with this is, again, I want to be clear about the problem I'm focused on. This presumably is the reason we care about financial instability. If it weren't for the macroeconomic consequences of financial crises, they would be little more than a curiosity. But they have terrible consequences in terms of our prosperity. They take a terrible human toll. And let me refine my statement just a bit. Our paramount worry when we talk about financial instability should be the types of crises that cause this kind of economic disruption. Other types of financial disruption are far less troubling, and they're not the subject of my book. The subject of my book is the crises that create these kinds of effects. All right, so I claim in the book that this disaster had something to do with the structure of our monetary institutions. So let's now get our heads around this. And we'll start with the basics, which everyone here understands. So we have a central bank. It's an organ of government, and it creates base money. Think of the green stuff in your pockets. If any of you carry this stuff in your pockets anymore, I actually almost never do. I just took this out of the ATM before this talk, so the green stuff is issued directly by a central bank, which is an arm of government. That's the first step of money creation in modern economies. And then we have the next step, which is the commercial banking system. So it's a truism of finance that commercial banks, depository institutions, are in the money creation business. This is Econ 101. If you took macro or money and banking in college, you understand how this works. So banks create deposit liabilities. Deposit liabilities function as money. In a prior era, it was banknotes, and then it became deposits. But it's the same general idea. And they've created these liabilities in amounts that far exceed their holdings of base money. So they really are in the business of augmenting the money supply. In fact, what you learned in Econ 101 is that the ratio of banks' deposit liabilities to their base money reserves is called the money multiplier. So in a very real sense, commercial banks do create money, and this is widely acknowledged and understood. What's somewhat less well understood is that modern financial systems have a parallel system of money creation. And I use the term shadow banking to describe this system. I use this term in a very precise way. Shadow banking has taken on a lot of meanings lately, but I use it in a very specific and precise way. To me, a shadow bank is any entity that uses large quantities of very short-term debt continuously rolled over to finance a portfolio of financial assets. That's a shadow bank, period. What is important to understand about this system is that the short-term liabilities of shadow banks are deposit substitutes. They serve a distinctly monetary function in a way that longer-term securities, no matter how safe, no matter how liquid, just don't serve. So there's a reason that these short-term debt instruments are classifiable as cash equivalents for accounting purposes. whereas longer-term securities are not classifiable as cash equivalents. You can't treat them along with your cash on your balance sheet. You have to classify longer-term securities as investment securities. There's a reason why economists have long referred to these short-term debt instruments as near monies. This is a term that never gets applied to longer-term securities, again, no matter how safe and liquid. There's a reason that central banks have long included certain categories of these short-term debt instruments in their monetary aggregates, whereas central banks have never included any longer-term securities in their monetary aggregates. Finally, there's a reason why in the financial world this market is referred to for short-term debt securities is called the money market, as distinct from the more familiar capital market in which stocks and ordinary bonds are traded. So this market really does play a monetary function. The holders of these instruments treat them as substitutes for deposits, which, again, we all recognize are monetary in nature. So let me lay out some, let's look at the institutional reality of money today for just a moment. So here's a picture which appears in chapter 1 of the book of what I call money claims outstanding. And I use the term money claims to refer to short-term debt instruments payable in cash or its equivalent, excluding trade credit. There's a few observations. So there's a lot of detail in this figure. There's a lot of different categories. Details aren't important for our person. These are all really simple instruments. They're all short-term debt instruments payable in cash or its equivalent. I've divided this up between sovereign money claims. So these are either issued directly or guaranteed by the U.S. federal government, or private money claims, which are issued which are neither issued nor guaranteed by the U.S. federal government. By the way, these are all dollar denominated. I'm only including dollar denominated instruments here. A couple of observations hop out here. First of all, this market's huge. This is $25 trillion on a gross basis. I'm just counting contracts. I'm not netting out those money claims that are held by issuers of money claims. This is just a gross aggregate. But 25 trillion is a big number, right? Just by way of comparison. Total outstanding U.S. mortgage debt, residential and commercial, is about 14 trillion. Okay, so this is a big number. Second observation I would make about this is that we saw a dramatic increase in money claims outstanding in the run-up to the crisis. So this goes from 1995 to 2013. I'd love to be able to go out further, but the data before the mid-90s becomes pretty unreliable. But we saw a massive run-up in this market, and particularly in the private component of money claims in the run-up to the crisis, followed by, with the onset of the crisis, a massive contraction in private money claims outstanding that was only partially offset by a massive increase in the amount of sovereign money claims outstanding. So we can think of this as sort of, as I said, the institutional reality of money today. If you look on the balance sheet of any, say, IBM or any corporate entity, and it has a cash and equivalence line, that line consists of some combination of all the instruments that are in this figure. This is the reality of how money works today. And we can see, again, a massive run-up in the pre-crisis years, followed by a contraction thereafter. And the contraction was a consequence of widespread redemptions of these instruments, which was the which happened in the acute phase of the financial crisis. So let me lay out some propositions about this market. So first of all, this money claim funding model, the use of large quantities of money claims continuously roll over, is pervasive in the financial sector. The money claim market is susceptible to panics. I use the term panic in a very precise sense. A panic, I'm going to quote Ben Bernanke here, a panic is a generalized run by providers of short-term funding to a set of financial institutions, period. That's all I mean by panic. Third, panics have a self-fulfilling dimension. Those of you who are familiar with modern banking theory will recognize this claim. It turns out to be quite controversial among experts, but I think the evidence in favor of it is quite strong. And finally, and perhaps most importantly, panics pose a uniquely grave threat to the broader economy. A panic is like a dagger to the gut of the broader economy. Remember, we looked at the economic disaster early in the Great Recession. I contend in the book and present evidence that that economic disaster was largely a consequence of the shadow banking panic that happened in between 2007 and 2009. And there are good reasons, I marshal evidence in the book, to think that panics are much more dangerous than other types of financial disruption. It's worth asking why panics are, what's the mechanism by which panics hurt the broader economy, and I'll give you what I think is the primary mechanism. So this is a picture of BBB rated corporate bond spreads. We have this data from 1925 through the present, so pretty close to a century worth of data. It was a monthly series up to 2000. Thereafter, we have a daily series. So this is the yield on BBB corporate bonds minus the risk-free rate. That's called the bond spread. And we can see two big spikes in this spread over the last century, two gigantic spikes, one in the early 1930s and one with the recent crisis. And of course, those are also the only two panic events we've had in the U.S. during this period. And what's happening here is when financial institutions need to meet redemptions of their outstanding money claims, in the early 30s it was deposits, in the recent crisis it was other types of money claims, but the mechanism is the same. They need to meet redemptions with cash, so they start dumping the assets that they hold. In the economic literature, this is called a fire sale. And so they're selling assets at distressed prices, and because asset prices and yields move inversely, this means that the yields or the spreads on these assets spike during a panic. And you might think this isn't such a big deal, right? So fine, some institutions have to sell assets on the cheap, but that means other institutions get to buy those same assets on the cheap, so we're just talking about a wealth transfer between two institutions, or two sets of institutions. But let's think a little more carefully about this. When yields rise to artificially elevated level, that then becomes the hurdle rate for new financing in the primary financing markets. So think about it if you're a lender. You're not going to originate a new financing transaction, a new loan, say, for a yield that's lower than the yield available on a comparable asset in the secondary markets. So what happens during a panic is there's a massive contraction in the supply of new financing to the economy, and because overall economic activity relies heavily on external financing, what you see is a collapse in overall economic activity. Note the story I just told you. I didn't say anything about failures of financial institutions. I didn't say anything about excessive debt in a generic sense or debt overhang. This is really a specific phenomenon to widespread redemptions of short-term debt. All right, so that's the problem. What do we do about this? My answer is, well, we already have an approach to this problem. It's called the U.S. insured banking system, and it's familiar to probably most of you, but here's essentially how it works. We have explicit government backing of the monetary liabilities of insured banks. In return for this, insured banks pay risk-based fees for this government backstop. And we also have portfolio constraints and capital requirements that we impose on this system to manage the moral hazard incentives that are an inescapable consequence of public support. So I happen to think there's a lot of merit in this basic approach for reasons that will become clearer in just a moment. But first, before I get into that, I want to point out that this system requires an essential prerequisite for it to work. And that is that money creation needs to be confined to this system. So banking law, at least in the US and England, has pretty much always sought to confine money creation to a set of specially chartered entities. This is what we call restricted entry in the banking business. And in practical terms, this means imposing a general prohibition. Okay, so here's the existing prohibition in U.S. law, 12 U.S.C. Section 378A2. My guess is that many of you, even if you've studied banking law, don't know what this is, at least at first sight. But this is actually, I would argue, the single most important provision in all of U.S. banking law. And what it says is, essentially, I'm going to paraphrase, thou shalt not maintain deposit liabilities unless thou hast a banking charter. Okay? So This is entry restriction into money creation, at least insofar as money consists of deposits. And note that this prohibition actually doesn't apply to banks. It applies to everyone else. Right? This is a general prohibition on all of us. We're not allowed to maintain deposit liabilities because we don't have a banking charter. So the first law of banking, as I call it, is actually a restriction on everyone that's not a bank from doing a particular activity. So my argument in the book is that this prohibition needs to be updated along functional lines. The category deposit, the legal category deposits, formalistic and obsolete. Other types of money claims are deposit substitutes, as we talked about earlier. They raise similar problems. Like deposits, they serve a monetary function. And so for this system to work, if we're going to use this basic structure, then the issuance of these other types of money claims needs to be confined to the system as well. The failure to do this, I argue in the book, is the failure to reach a functional legal definition of what constitutes a monetary instrument is the original sin of banking law, and it is, I think, the primary source of our current regulatory troubles. All right, so some observations about the system. So let's suppose we did what I just described. We say only insured banks can create money. No one else can issue money claims on a meaningful scale. De minimis exceptions are fine, but let's just imagine confining this funding model to the insured banking system. What are some features of this system? So first of all money becomes sovereign. The system is panic-proof. The entire broad money supply, not just deposits, becomes fully sovereign and non-defaultable. I'm imagining here that we do away with the existing cap on deposit insurance coverage of $250,000. You know, we discard that cap whenever there's a major disruption in the banking system anyway, so we might as well not pretend that that cap is operative. So once you discard the cap and once you confine money creation in the system, money creation, money becomes fully sovereign and non-defaultable. This system is a public-private partnership. We can think of this as a joint venture with the state for the issuance and circulation of money. Once you've confined money creation to this system, the monetary authority can control the total amount of money issued and can use this control in the conduct of monetary policy. So historically, reserve requirements in the banking system have played this role, although they haven't been binding for some time. This system has worked pretty well in the past. So in 1933, after the worst panic in U.S. history, and at the deepest point of the Great Recession, Congress created federal deposit insurance. This was a quantum leap forward in monetary system design. The bulk of the U.S. money supply in one fell swoop went from private to sovereign, and the creation of this system inaugurated an unprecedented 75-year of panic-free conditions in the U.S. financial system. Gary Gorton, a Yale economist, has written about this extensively. He calls it the quiet period in U.S. banking. And the important part is that this period was also one of remarkable macroeconomic growth and stability, notwithstanding the occasional recession. And this is not a coincidence, I believe. The absence of panics during this period was a major factor behind the absence of macroeconomic disasters. It was only with the large-scale emergence of shadow banking, money creation outside the insured banking system, that instability returned, and with it came the Great Recession. Finally, the system I'm describing, as I alluded to at the beginning, is fairly conservative. Right? It's conservative in the sense that this isn't a radical overhaul. There are no new institutions or regulatory techniques. This is a modernization of our long-standing system of money and banking along functional lines. And doing this, I argue, dealing with money creation in a functional way, could set the stage for a substantial scaling back of other forms of financial stability regulation. In other words, if we dealt with money creation in a coherent way, we could stop trying to do a bunch of other stuff. Okay, we would have protected the economy from severe disasters. All right, so that's the system that's an outline of the system I favor. There's some components I'm leaving out here, but this discussion raises that basic question, which is why involve the private sector in this at all, right? So why not have the government? Why not have direct issuance by the federal government of the entire broad money supply. Lest this seem far-fetched, it's worth pointing out that one version of this proposal, called 100% reserve banking, has a very distinguished intellectual lineage, going back again to Henry Simons and Irving Fisher. Milton Friedman was a proponent. Various other Nobel Prize-winning economists more recently have been proponents. So this isn't a fringe idea. And just to think this through for a second, let's simplify even further. Let's just imagine we all hold our monetary accounts directly with the central bank. Okay, so there's no intermediary at all. Let's just say we have a central bank. It issues accounts that are the only monetary instruments available. Ignore privacy issues for a moment. I want to focus on another set of problems with such a system. So in such a system, the central bank would control the entire money supply by buying and selling financial assets, just as it does now. Presumably, we would want it to stick with Treasury securities if possible. But therein lies the major problem, which is there may not be enough Treasuries to accommodate the desired money supply. So if that's the case, then the central bank would need to expand into private credit. But expanding into private credit raises two problems. The first is a problem of credit analysis. It's extremely difficult. Presumably, we might want to harness some private incentives, harness market forces in the task of allocating credit. Second, if the central bank's doing it directly, then we have the problem of perceptions or reality of favoritism by the government. So my answer to this question, why not have the government do it all directly, is that there are good reasons to outsource this credit allocation function. The system I envision in the book and that I described a moment ago, I said it's a public-private partnership, and the idea is that we're going to harness private incentives to engage in the credit allocation process. It's worth noting that what I just described is the system I just described is compatible with any fiscal environment, right? So you don't need a government debt to make the system work. In fact, you could have a permanently balanced budget and zero government debt, and we would still have a functioning monetary framework in this system. And I think there are very good reasons why we would want our monetary framework to be independent of or compatible with a variety of different fiscal environments. All right, finally, this raises one more question, which I think is interesting, which is what about seigniorage? Seigniorage, as you all or many of you probably know, is government revenue that arises from money creation. So the Fed today, central banks today earn returns on their asset portfolio. They deduct their expenses, which are quite small, and then pass the remainder on to the Treasury Department. That's revenue to the U.S. government. It's a large item. It's on the order of $100 billion a year right now, so this is a big fiscal revenue item. So in the scenario where the government monopolizes all of money creation, it receives the entirety of the seigniorage fee stream that comes from investing the money supply in circulation. But once we introduce, what happens when we outsource money creation, as I've been describing? You can imagine that the privately owned banks might then capture this value, thereby reducing seigniorage to the government. But this need not be the case. Outsourcing credit allocation does not necessarily imply the government giving up seigniorage. On the contrary, I argue in the book, the government should give up no more value than necessary to induce its joint venture partners to do a good job. Okay? And so we currently do charge fees to insured banks, deposit insurance fees, but we shut those fees off when the deposit insurance fund is fully funded. The logic I've just described suggests we shouldn't shut them off. They should become a fiscal revenue item, which we can think of as a form of seigniorage. So this analysis, I think, shows how thinking about monetary system design in an integrated way enriches our understanding of existing banking regulation, both its virtues and its defects. Finally, I'll tick through a couple other potential objections to this system. So the first is regulatory arbitrage. So one argument I get a lot is, no matter how much you try to confine money creation, the financial sector, the wizards in the financial sector are going to figure out a way around this. So, regulatory arbitrage is a fancy word for avoidance. I used to do regulatory arbitrage for a living, so I don't think I'm naive about this. I contend, there will always be regulatory arbitrage in every area of economic regulation. That's not unique to this system. In fact, I contend that the system I'm describing is actually a lot more feasible than a lot of other things we're trying to currently do in financial regulation. Okay, so what about moral hazard? So there's the argument that I'm increasing moral hazard because I'm backstopping the entire broad money supply after we confine its issuance to the insured banking system. I actually think the opposite's true. I think the system reduces moral hazard because currently the federal government has in place, like it or not, a very broad backstop of very large segments of the financial sector. This results in distortions and subsidies, and I'm talking about withdrawing support from the rest of the financial sector and having the backstop apply only to insured banks, which are required then to exist within a very special regulatory apparatus that includes risk-based fees, which are designed to extract the subsidy back to the government, and also includes very strict portfolio constraints and capital requirements to deal with the effects of moral hazard. We can never fully get rid of moral hazard. It's essentially a cost of business and monetary system design, but we can design the system to deal with it, to confront it directly and deal with it rather than trying to pretend or hope that it doesn't exist. The third objection is that this will be costly to the financial sector, reduce financial sector profits, and will increase bid-ask spreads in the financial markets. And my answer is I plead guilty on this. It probably, almost certainly, the system will lead to lower profits in certain segments of the financial sector because it's very profitable to fund yourself with overnight debt that's rolled over continuously, particularly when the federal government's backstopping that. So this isn't the end of the world to see some costs go up. Bid-ask spreads today are in effect publicly subsidized, so removing a public subsidy is certainly costly to its beneficiaries, but that's a private cost, not a social cost. It's not one that we should be that concerned about. Finally, costs need to be compared against benefits. If panics are a preeminent source of severe recessions, then the benefits of panic proofing would be immense. Just always keep in mind the first graph we looked at the path of GDP. Think about the cost of panics. You have to have a lot of costs to outweigh the benefits if panic proofing does away with that problem. A fourth objection then is the question whether panics really are the main problem, as I've suggested. And this is a debatable proposition. My overall argument depends on this proposition, and it's subject to chapter 4 of my book. I think the evidence is strongly in my favor that panics pose a uniquely grave threat to the broader economy. And the final objection is, why don't we use other alternatives such as margin requirements for short-term debt instruments, or expansion of the lender of last resort, or modification of the lender of last resort? And my answer to that is these are half measures. They don't fully solve the panic problem, and they also don't take into account the broader implications of private money creation in terms of distortions in asset markets, in terms of the conduct of monetary policy, and in terms of the capture of seigniorage. Finally, this is my last slide. Final thoughts on monetary system design. This is a quotation from Milton Friedman in 1960. Something like a moderately stable monetary framework seems an essential prerequisite for the effective operation of the private market economy. It is dubious that the market can by itself provide such a framework, hence the function of providing one is an essential governmental function on a par with the provision of a stable legal framework. So Friedman, this is our great champion of laissez-faire in the 20th century, right? He got more laissez-faire after this statement. So this is from 1960. However, he revisited this exact statement in a paper he wrote in the late 1980s, and he declined to renounce this position. So even our great champion of laissez-faire believed that the provision of a monetary framework is not something that's going to emerge spontaneously from market forces. Money creation, then, is an essential function of government. It's one that has been strangely neglected, for the most part, by legal scholars There are some notable exceptions. Some of them are sitting here. Legal scholars devote huge scholarly resources to the study of all the other legal institutions of capitalism, but we've spent very little time, precious little time, studying money qua money. This strikes me as a mistake. Structuring institutions is one of our specialties as lawyers. And the engineering of monetary systems is a major project of statecraft. Monetary institutions, like all legal institutions, stand in need of design, and some designs are better than others. I'll stop there. Thanks. If we have time, I'm happy to take questions.
Yeah, there's questions.
Hi, thank you for coming in. It's great. I really enjoyed it. So my question involved the USC 378A2. You said you would revise that. So how would, I was just wondering, how would you revise it to capture, I saw that you had included money market funds, but not other potential short-term run-of-the-mill vehicles. Probably they're not as big, but how would you legally define it? Or would it be something that you're constantly updating and changing?
Yeah, so this is a really important question about how you do it, and it's so important that I actually drafted the statutory text and put it as an appendix to Chapter 9 of the book. This is one part of the statute that I actually just wrote down because it's sufficiently important that we establish whether it's doable. Part of the reason I wrote it down was to shift the burden onto people that said it's infinitely arbitrageable no matter how you do it, because I've written it down now, so try it. And, but the answer to your question is you have to capture not just money market funds, but all varieties of what one might call money market debt. And this does pose some challenges of definition. And I do think we need some rulemaking powers under the statute, which I include in my text, to allow for dealing with this issue over time. I would say that, one way of thinking about how you would go about tracking this over time is whenever the financial sector starts to lobby the accounting authorities to include any class of instrument as cash equivalent for accounting purposes, you're onto something there, right? That's a red flag that they're creating something that's acting like money and should be treated as such. It may not be a fully satisfactory answer, but I would encourage you to read the chapter when you have some time and see if it works for you. That's right.
So Matt Levine used a version of your argument to say that we could use that instead of designating certain institutions as systemically important. Do you think that follows, or is that kind of a misuse of what your system would look like? Would you still have systemically important financial systems?
Well, Matt, so how many of you read Matt Levine? Matt Levine is a former colleague of mine in legal practice. I actually interviewed him for his first job at law school. And he's now a blogger at Bloomberg View and is just absolutely essential reading for anyone interested in finance. He did derivatives at Goldman for a while after legal practice, and now is a financial writer. He's saying we could do this in lieu of systemic designations. I think that's exactly right. In other words, in the system I envision, we wouldn't have this. I'm sure many of you know because you've studied this or read about the MetLife decision last week. So we created the Financial Stability Oversight Council of Regulators that then designates individual firms as being SIFIs, systemically important financial institutions. And once they're so designated, they become regulated by the Federal Reserve. So this is to deal with the kind of AIG problem that was confronted in the recent crisis where it had no real federal regulator. I'm somewhat skeptical of this basic approach to doing financial stability regulation because I think the real problem is panics in the market for money claims, and I'd rather just deal with that problem in a very direct and structural way, in which case we wouldn't have to worry about supposed systemic problems arising outside of the money creation system. So that's probably a long-winded way of saying that I agree with Matt on this question. Yes?
Traditional deposit insurance can be understood as involving kind of quid pro quo. The government provides insurance, it gets fees, but in addition it imposes capital requirements and takes other measures to ensure that the institutions whose deposits it's insuring remain creditworthy. In your proposal, applying for instance to money market funds, do you foresee a similar kind of quid pro quo? Capital requirements or margin requirements or something else to ensure?
Yeah, so in the pure version of my system, there's no such thing as a money market fund, right? I mean, I think, and look, I think I've heard a current or recent SEC commissioner say this, and a former member of the Federal Reserve Board say this, who was around at the time in the early 80s when Rule 2A7 was adopted to create the modern money market fund industry. This was just a mistake. We shouldn't have gotten the SEC in the monetary business. The SEC should regulate investment companies that are designed to be long-term investment vehicles. When I say long-term, they're meaning that the claims on these mutual funds vary in price, and we shouldn't have let deposit substitutes arise outside the banking system. So the way I would answer your question is, in the pure version of my system, there wouldn't be any such thing as a money market fund. We'd have one banking system regulated by the banking regulators that is the exclusive issuer of monetary instruments, and they would all be subject to a uniform set of constraints, including capital requirements and portfolio constraints, and charging risk-based fees. So I recognize that at some point you have to bow to reality. We do have a system of money funds. My preferred, if we're going to keep that system, my preferred approach would be to take as much of this system and apply it directly to them as possible. So that would include both capital requirements and portfolio constraints. Portfolio constraints already apply to money funds, but capital requirements too. I would say one more point about this, which is, if you really did my system, but you didn't get rid of money funds, the truth is prime money funds, which invest in private short-term credit, wouldn't really exist anyway because they wouldn't have anything to invest in, right? The rest of the money supply would be sovereign, issued by, short-term debt would be almost exclusively issued by the insured banking system. And so all money funds would be government funds, and we're kind of less concerned about those anyway. So there's a kind of backdoor way of dealing with that problem. I don't know if that fully answers your question. In back?
Yeah, I just wanted to push on the idea that panics outside of banks are the main unsolved problem. It seems like panics within banks in 2008, the savings and loan crisis, seem like still major parts of the story, and suggest that just kind of pushing money into banks may be insufficient. And then two, looking at the huge buildup of debt over the sort of middle part of the 20th century, maybe even if that doesn't explain the specific cause of the crisis, that's a better account of the persistence of it, and that's what we're maybe more concerned about than stop the crisis.
Yeah, so these are both great points. I mean, so on the point about panics within the insured banking system, so we've never had a panic in insured deposits. There have been some widespread redemptions of deposits that are uninsured, in other words, over the cap. We saw that at Washington Mutual and Wachovia. That's why we lift the deposit cap whenever that starts happening, the deposit insurance cap, so that we just insure everything. We insured all transaction accounts to an unlimited amount in the recent crisis. And the S&L debacle is a great case in point here, because it was a debacle, right? I mean, the thrift industry had insured deposit liabilities, but we did some really unwise things in the 1980s, particularly in the very beginning of the decade. We really loosened up portfolio constraints. We let them get into junk bonds. We let them get into commercial real estate development that they didn't know how to do, and it's extremely risky. Predictably, they loaded up on risky assets to try to build themselves out of a capital hole that had already existed due to the increase in interest rates. And they lost a ton of money, and we ended up having to bail them out. And it cost taxpayers $125 billion. Now, we can all gasp at $125 billion. It's a big number. But keep in mind what did not happen. We didn't have an economic disaster. Right? We didn't have a panic. There were not widespread redemptions of deposits in the 1980s on a broad scale. There was, people knew that their deposits were insured and that they would be honored by the Deposit Insurance Corp, the FDIC, and therefore they didn't redeem en masse. And what we had in 1991 was a very mild and ordinary recession for which ordinary monetary policy was perfectly sufficient to get us out. And that's why I think it's really important to keep in mind what problem we're trying to solve. Not solving the problem of financial crises in some generic sense, but trying to deal with the subset of crises that really tank the economy. And those tend to be overwhelmingly, in both U.S. history and, I talk about this at some length in Chapter 4. I mean, there's an incredible correlation between panic events and severe economic disruptions in peacetime modern economies. And I think that there's very strong evidence that this should be treated as our main problem. Your other question about excessive debt, I don't deny that excessive debt could be a macroeconomic problem and maybe is impeding the economic recovery. Paul Krugman has made this argument, among others. But it seems to me our our first priority should be, panics are like a dagger in the gut to the real economy, and we should try to prevent these traumatic events from happening in the first place. That should be our primary focus, and perhaps a secondary focus should be on limiting the amount of debt overall in the system to the extent that impedes recovery. Professor Desant.
So, Morgan, as you know, I think it's a fantastic project, and I love the focus on monetary design. Okay, I have I'm particularly interested. I have a sort of two-part question that starts with seniorage, because it's not very often. One of the things that you bring to the table that very few people do is an emphasis on seniorage. So, my first part of the question is, do you have estimates for the dimension of seniorage? And if I'm following you that are currently being reaped by commercial banks. So if I'm following you, that would be the excess of their profits from money creation over the amount they pay in insurance. And when I asked some version of this question to Michael Bordeaux once, he said, well, we don't call that seniorage, we call that profits, right? Which leads me to the other part of my question. If we think of it as profits, if in fact this was a private activity that was that banks generated. And so the second part of my question is to push you a little bit on your acceptance of money as a private activity, say before the 1930s. And I'm not sure if that's a strategic or conceptual move on your part. So the prohibition, to push a little bit, and you say, the restriction on money creation, that prohibition is the first law of banking. I'm wondering why you don't instead say, it's completely clear in the 19th century that without permission, without government support, none of those state banks would have remained in existence. So that, state governments were taking banknotes and taxes, and they were recycling and taking loans from state banks. They were basically supporting the state banking system. Couldn't one make, in fact, indeed, one can make the same argument about shadow banking. It only exists because of government assets, government clearing, government payment system. So why not, acknowledge, locate the public structure of money and the public nature of money creation, which would indeed make all seniorage public?
So I'm not foolish enough to argue with Christine Desant on questions of financial and banking and monetary history. So I'm agnostic on whether we should call it a public or private activity. What I mean by private in this particular context is that the instruments are defaultable. So the distinction between sovereign and private money claims that I put on my chart of money claims is just a distinction between those instruments that are essentially non-defaultable because they are really explicitly backed by the sovereign, and those that we are willing to allow default. And that is, maybe we can object to whether we use the public-private distinction for that, but that's the real thing I'm getting. When I talk about private money, I mean defaultable money. The green stuff again. There's no legal sense in which this is defaultable, right? Its value can erode if we issue too much of it, and so forth. But it's not. We're not going to wake up one day and say, "Oh my gosh, my $20 bill defaulted," right? There's no sense in which that can happen. Same true for insured deposits. If we really believe in deposit insurance, there's no sense in which your insured deposit can default because the sovereign's backing it. So that's the distinction I want to draw there. Not whether you need public infrastructure for this business model to arise in the first place, which is a proposition that I accept. On your first question, I forgot your first question. Sorry.
The dimension of seniorage.
Oh, dimension. I don't know what the dimension of seniorage is. Bordeaux's comment that we call it profit when it's private is, to me, this is semantic, right? We should be charging. Let me just put it this way: we should be charging an actuarially fair rate to banks that are in the business of money creation. And what I mean by that is we should be seeking to approximate the financing cost that the bank would incur if it were financing itself in the ordinary private capital markets like everyone else, right? And once you do that, whatever amount that is, and I think it's hard to estimate, but to the extent we're charging them less than that, then I would call that private seniorage, right? It's private capture of what properly is a public asset. And we don't think about banking in this way now. It's treated as excessive. This goes back to the other question. It's treated as a very private activity, and the idea that we're supposed to be reaping some kind of governmental revenue from this seems shocking to some people, but we've always got revenue from money creation, right? That's what seniorage is. It's a public activity. So I hope that's satisfactory. But in terms of the magnitude, I don't know. I don't know quite how to quantify that. Yes.
I have a few questions. First,
Okay, this will be the last one.
kind of just a clarification.
Yeah.
Do you think that the change over the course of the 20th century can get, or a better way of asking it is what you're describing we should go to possible just by changing kind of administrative interpretation and administrative level rulemaking? Because the changes that allowed for the creation of the Shepherd banking system as a historical matter were really not the product of congressional statutory changes.
Whether the practical answer to that is no. The practical answer to that is that we need this to be a political bargain, and Congress needs to get involved. I don't think there's any feasible way that the Fed or other financial regulators can say, oh, we changed our mind. All this stuff is deposits, and therefore only insured banks can issue them. That would not be. That would be a recipe for the end of the independence of our banking agencies and our central bank. And so I think as a matter of political realism, I don't think that's a path that's realistic. I think we need legislative change.
And my second question is, you do have that clear line between what is backed by the deposit window or open market operations and what isn't. Does that necessarily force the government into the business of a form of industrial policy, or is there a way to do underwriting through open market operations with a discount window without kind of picking winners and losers?
Well, so I don't like to think of it as industrial, but part of the reason I want to outsource the actual credit allocation in the economy is precisely because I'd like for that to be somewhat independent of governmental direction, right? Let's let that try to let that be governed by market forces to the extent possible. Nevertheless, someone's got to price a deposit insurance premium, and you're picking winners and losers in the sense among banks because you have to decide when they're insolvent and taking them into receivership and whatnot. There's no getting around that, right? There are, this money creation is a government activity. It takes a real commitment of resources and expertise, and there's no way to do it in a perfect way that doesn't involve any judgment. We should be trying to set up institutional structures that we think will work well over the long term. Okay, I'll stop there. Thank you. With conceptual blinders. To set the stage for my argument, I want to first be clear about the problem I'm focused on. So here's a picture of the Great Recession in the United States. The diamonds here in this figure represent, I think my laser's not working. Oh, there it goes. The diamonds represent U.S. real GDP on a quarterly basis. I'm going here from 2004 through the end of 2014. So we can see, of course, a major drop-off in real GDP with the onset of the crisis and immediately thereafter. The gray line in this figure represents the Congressional Budget Office's estimate of potential GDP. So this is what GDP would be if the economy were operating at its underlying potential, if we were at full employment essentially. So the difference between these two things, between actual and potential, is referred to as the output gap. And so we see a major widening of the output gap immediately after the crisis. But we seem to see some good news here in that the output gap has gradually narrowed since the crisis. In fact, we're operating at this point pretty close to potential. So this is the positive interpretation of this figure, but now let me offer you the more pessimistic and I think more realistic interpretation of this figure. So the plus signs here are the CBO's projection as of 2007, when it projected this book was born of the financial crisis. So I watched the crisis unfold from a trading desk at a big hedge fund, and I left that hedge fund and joined the U.S. Treasury Department in early 2009. I worked there on financial stabilization as well as financial regulatory reform. And I was convinced then and remain convinced that financial regulatory reform in the post-crisis period has been largely on the wrong track. And I believe the failure has been mostly conceptual and not political. So we haven't thought carefully enough about the nature of the underlying problem, and we haven't envisioned solutions in sufficiently structural terms. So I'm offering in this book a different way of thinking about how to do financial stability regulation. In the preface of the book, I suggest that we should approach financial regulation or regulatory design in general the way that Steve Jobs approached product design. So we should be aiming for simplicity and elegance. We should be skeptical of hyper-technical complexity. We should be asking what features we can safely omit. In short, design matters. Engineers sometimes say that simplicity is a prerequisite to reliability, and I think this is all the more true in the design and structuring and engineering of legal institutions. So the book has a programmatic dimension, but I should emphasize at the outset that the program isn't radical. In fact, in some ways, it's fairly conservative. The program builds on institutional structures and techniques that have been in active use for many decades in the United States, and I argue that our long-standing system of money and banking in the U.S. embodies a coherent economic logic, and the main task of financial reform should be to follow through on that logic. But first, we need to understand that logic. So, with that, let me start. If this works, should have tried this before. There we go. What's the core argument of the book? So the book, as I just mentioned, is about financial instability. It's also about the structure of monetary institutions. And these two things, I argue, are one and the same. So financial instability is largely a problem of monetary system design. This may sound like a strange statement. We aren't accustomed to thinking of financial instability in this way. In fact, we're accustomed to thinking of these two things as really distinct from each other. But it's worth pointing out that in an earlier era, this statement would have been treated as self-evident. So if you'd asked Irving Fisher in the 1930s, or Henry Simons, one of the founders of the Chicago School of Economics in the 1930s, they would have said that this statement is a tautology. But we've, I think, lost sight of this insight and what it means, and as a result, we've approached financial reform. Potential GDP would be going forward. And as you can see, the trajectory there essentially follows along the previous trajectory of the economy. And the CBO's current estimate of potential GDP bends down very significantly from what it had previously projected. And so this phenomenon is what Larry Summers and others have referred to as hysteresis. Hysteresis is the doctrine that the lack of output in the actual economy, the fall off in the diamonds, has in effect caused an erosion in the economy's underlying productive capacity. So this is like a muscle that atrophies if you don't use it. And the reason this is important is because it suggests the counterfactual scenario we should be thinking about is not that we stayed on the gray line, but that in fact we followed the plus signs, right? That's the counterfactual macroeconomic scenario, arguably, that we should be focused on. And if we think about the crisis and the cost of the crisis in this way, it's much more troubling, right? The crisis had a level effect on output. We appear to be on a trajectory, a permanently lower trajectory to the tune of something like $1 trillion lower GDP than we had previously anticipated. And if you take $1 trillion into perpetuity and discount that back to the present at any reasonable discount rate, you're going to get a present value of lost output in the tens of trillions of dollars, which is just staggering. The reason I start with this is, again, I want to be clear about the problem I'm focused on. This, presumably, is the reason we care about financial instability. If it weren't for the macroeconomic consequences of financial crises, they would be little more than a curiosity. But they have terrible consequences in terms of our prosperity. They take a terrible human toll. And let me refine my statement just a bit. Our paramount worry when we talk about financial instability should be the types of crises that cause this kind of economic disruption. Other types of financial disruption are far less troubling, and they're not the subject of my book. subject of my book is the crises that create these kinds of effects. All right, so I claim in the book that this disaster had something to do with the structure of our monetary institutions. So let's now get our heads around this, and we'll start with the basics, which everyone here understands. So we have a central bank. It's an organ of government, and it creates base money. Think of the green stuff in your pockets. If any of you carry this stuff in your pockets anymore, I actually almost never do. I just took this out of the ATM before this talk, so the green stuff is issued directly by a central bank, which is an arm of government. That's the first step of money creation in modern economies. And then we have the next step, which is